Hey everyone, and welcome to this explainer. Today, we're putting Verizon through the absolute ultimate investment gauntlet. As an investment analyst, I can tell you that finding a company's stock price takes about 2 seconds, but discovering its true intrinsic value, well, that is an entirely different ballgame. So we're going to be dissecting this telecom giant using the time-tested frameworks of legendary investors, Warren Buffett, Peter Lynch, and Benjamin Graham, before we stress test it with modern discounted cash flow and alternative valuation models.
We've got a lot of ground to cover, starting with a quick company snapshot. Then we'll move through the Buffett, Lynch, and Graham models, run our quantitative DCF, and bring it all together for a final verdict. Let's jump right in.
Section 1, the Verizon Company Snapshot. First things first, we need to establish the ground truth of their operations today. Verizon is currently trading right around $46.54. But let's be real, what absolutely jumps off the page for income investors is that massive 6.1% forward dividend yield. In a market where standard yields are always bouncing around, locking in a reliable payout like that from a $194 billion juggernaut, that definitely demands our attention.
But, a dividend is really only as safe as the underlying business. Right now, Verizon is actively navigating a pretty massive turnaround under CEO Dan Schulman. They just set up a huge $4 billion international enterprise joint venture with BT Group, which is a big deal for their global footprint. However, we've got to talk about the elephant in the room, the balance sheet. They are carrying a hefty $142.5 billion unsecured debt load. That debt is absolutely going to be a crucial variable as we run our models.
Section 2, the Buffett lens.
Let's see how Verizon holds up when we look through the eyes of the Oracle of Omaha. Now, Buffett prioritizes economic moats, reliable management, and really strong cash flow. He loves transparent leadership, and recently, CEO Dan Schulman came out and said, "We are beginning to reclaim our market leadership." And honestly, the data is actually backing him up. Verizon just reported their first positive first-quarter postpaid phone net adds in over a decade. When a legacy telecom actually starts growing its core subscriber base again, instead of just bleeding them out to rivals, that's a massive signal that their economic moat is genuinely widening.
But there's a serious tug of war in their financials if we're strictly following Buffett's rules. On one hand, Verizon boasts a rock-solid 16.8% return on equity. That is exactly the kind of capital efficiency Buffett applauds. But on the other hand, remember that $142.5 billion in debt? Yeah, that translates to a debt-to-net income ratio of 8.0 times. For a conservative investor who obsesses over pristine owner earnings, that is flashing red. Buffett generally wants to see companies that can clear their debt with just 3 or 4 years of earnings. Because of that leverage, he would absolutely demand a massive margin of safety on the stock price before even thinking about buying.
Section 3, the Lynch lens.
Shifting gears to Peter Lynch. Now, Lynch famously loves categorizing companies to set the right expectations, and he obsessively tracks the PEG ratio, that's price to earnings growth. Based on their current trajectory, Lynch would likely classify Verizon as a turnaround stalwart. Now, let's run his favorite math. We take their current P/E ratio of 11.4 and we divide it by their estimated forward EPS growth rate of 6.3%. That gives us a PEG ratio of 1.8. Since Lynch generally prefers to buy when the PEG is under 1, meaning you're basically getting the growth at a discount, this 1.8 score makes Verizon a solid hold for him until either the price takes a dip or that turnaround growth really kicks into high gear.
Section 4, the Graham value test. Next, we submit Verizon to the godfather of value investing himself, Benjamin Graham. Graham's approach is intensely quantitative. He uses a rigid defensive checklist to protect against downside risk. And surprisingly, Verizon holds up really well here. Adequate size? Yep, $194 billion market cap easily clears the bar. Consistent dividend? Yes, that 6.1% yield is baked in. Moderate multiples? Absolutely. With a PE of 11.4 and a price to book of 1.9, Verizon is priced way below the broader market average. It breezes right through his initial screen. But Graham was a math guy, right? He doesn't just stop at a checklist. Extracting their trailing earnings per share of $4.08 and book value of $24.49, we can run Graham's legendary intrinsic value formula, the square root of 22.5 times EPS times book value. Crunching those numbers gives us a strict, historically grounded intrinsic value of $47.41 per share. And here is the catch. With an intrinsic value of $47.41 and a current price of $46.54, that is barely a 2% margin of safety. Graham was notoriously, sometimes even painfully, risk-averse. He usually demanded a 33% margin. So honestly, he wouldn't touch this stock today. He'd just sit on his hands and wait for the market to panic, hoping the price drops closer to $31 to guarantee his downside protection. Section 5. DCF and Alternative Models. Let's step away from the legendary gurus for a minute and jump into modern quantitative finance. Ultimately, a company is worth the present value of all the cash it'll ever generate. So, building out our base case discounted cash flow, we project an annualized free cash flow of $19.6 billion. We're assuming a super conservative terminal growth rate of just 1%. And for the discount rate, the weighted average cost of capital, we have to use 7.5% to properly account for the risk of that massive debt load we talked about earlier. Run all that through the model, and our base case DCF yields a fair value of roughly $55 per share. But here's the thing about DCF models. You can never just rely on one number in a vacuum. We have to run a sensitivity analysis. Look at how sensitive that $55 valuation is to interest rates. If borrowing costs stay sticky and that WACC pushes up to 8.5%, the fair value plummets right back down near the current $46 share price. Because of the leverage, this valuation is incredibly sensitive to macroeconomic shifts.
If we pivot and look at a comparable company model, evaluating Verizon against its direct peers, it sits right smack in the middle of the pack. At an 11.4 PE, it's significantly cheaper than T-Mobile, which trades at a premium 19.4 PE because of its faster growth. But Verizon still carries a slight premium over its legacy rival AT&T, which is sitting down at a 7.7 PE. So it's priced pretty appropriately for its neighborhood.
And for our final quant check, Verizon scores a highly impressive 90 out of 100 on overall value. That massively outperforms the wider communication services industry average of just 64. By almost every conventional metric we look at, price to earnings, price to free cash flow, price to sales, Verizon is objectively cheap. Section 6. Synthesis and Final Verdict. All right, it's time to bring all the pieces of our detectives board together. Blending our models gives us a really clear picture. Graham's historic formula gives us $47 and change. A standard dividend discount model puts it right around 47 as well. And our baseline DCS stretches up to 55. With the current price sitting at $46.54, Verizon is trading basically right at or just slightly below its fair intrinsic value. So, synthesizing all of this, Verizon is a highly compelling hold for income-focused investors who just want to lock in that juicy 6.1% yield while management actually executes this turnaround. But I want to leave you with this to ponder as we wrap up this explainer. With the turnaround momentum finally building and free cash flow expanding, at what specific price point does that massive debt load become irrelevant? At what price does this stock become an absolute unignorable buy for Buffett, Lynch, and Graham alike? Keep a close eye on those cash flows and definitely keep your valuation models updated. Thanks for diving into the numbers with me today.